A warm welcome to the FactSet Insight podcast. The voice you hear is Guy Adami. The next voice you hear will be that of Dan Nathan, my partner at Risk Reversal Media. Dan, how are you?
I'm doing great, Guy Adami.
But the voice that you want to hear is that of John Butters. He's the senior earnings analyst at FactSet, and we have basically taken over his podcast. John, how are you?
Doing great. And Dan and Guy, thank you guys as always for guest hosting here. We always appreciate you guys doing this and getting your perspective on the earnings season as well. So
listen, we love doing this. We love having you on. We love having your work on a weekly basis. FactSet obviously has been a tremendous partner with us. So let's get right into it. As we sit here in early November, things seemingly continue to come up roses for the market, and it's doing that, John, through the lens of earnings. So let's talk about that.
Yep. So we're about 2/3 of the way through the earnings season at this point. The growth rate's at 10.7%. But before we get into that, I kind of want to talk about the setup coming in this earnings season, because I think it's important to note we've had one of the most positive setups we've seen coming into an earnings season in quite some time. So if we go back to June 30th, the expected earnings growth rate for the S&P 500 was 7.3%. And during the course of the quarter, estimates actually increased over that time frame. Analysts in aggregate increased their estimates, their EPS estimates. And this is due to a lot of positive guidance that came out. We saw a number of companies, particularly in the technology sector, put positive guidance out. And as a result, at September 30th, at the end of the year, at the end of the quarter, the growth rate is up to 7.9%. And since September 30th, over the past month, we've seen an unusually high number of companies report positive surprises. So overall, 83% of the company in the index have reported a positive surprise. That's well above the 5-year average of 78%, the 10-year average of 75%. And if we stay at 83%, that'll be the highest number going back 5 years. And as a result, that's pushed the growth rate from the 7.9% back on September 30th up to 10.7% today. And at 10.7%, we'd be looking at our fourth straight quarter of double-digit earnings growth for the index.
Yeah, it's pretty amazing just thinking about it, and those numbers you lay out there, John. It's kind of hockey sticks over the last, few months or so in Q3. Give us a sense, though, put this in some sort of context, right? Like, how frequently do you see this sort of kind of acceleration relative to expectations into a print? And does this largely have to do with the fact that expectations came down a lot if you go back to early April in Q2?
Yeah, we did. I mean, like I said, we certainly did see the estimates come down earlier in the year, and we saw an inflection point probably during the last earnings season where the estimates started to go up, which would be, again, around the same timing of the start of the third quarter. So it is interesting. In a typical earnings season, we would generally see a U-shape, right? The estimates would start high, the numbers would come down as analysts lowered their estimates, and the companies would beat those lowered estimates, would come back up. But in this case, we basically have a straight shot left to right of going from low to high. Now, I will say, one sort of negative or one sort of thing to watch in this earnings season, the reaction to the positive surprises and negative surprises haven't been what we've typically seen. So, for example, companies that have missed estimates have seen a lot larger drop in their stock price after reporting, and companies that have reported positive surprise haven't seen the usual increase in prices that we typically see. So that is something to keep an eye on, in spite of, the generally positive news we've seen overall for this earnings season.
As your audience knows, the S&P 500 is broken down into 11 sectors, and we've learned over the last few years with your work, there have been winners and there are losers, and this speaks to exactly that, and you've broken it down by the S&P 500 smack in the middle, and obviously the 11 sectors that comprise it.
Yeah, so overall, we got 8 of the 11 sectors reporting growth for the quarter. 4 of those sectors reporting double-digit growth. We're led by, once again, the information technology sector at 27%. And as you guys know, we've talked about this sector the last several quarters. It's been one of the leaders in terms of growth. Within that sector, the semiconductor space is really driving growth. They're at 50% growth. But all 6 industries in this sector reporting growth. Tied for second, we've got both the utility sector and the financial sector at 21%. So within the utility sector, again, fairly broad-based growth across the 5 industries, all 5 industries reporting growth. Energy is one of the drivers of growth there. If you take energy out, that growth rate drops to about a third, down to 14% from 21%, but still double-digit growth for utilities. And the financial sector, another sector we're seeing very broad-based growth. All 5 industries in this sector reporting double-digit growth. And this is a sector where it's been one of the largest contributors to the increase in the growth rate we've seen since September 30th. So financials coming into the quarter, we're looking for about 11% growth, again, up to 21% growth now. And they're one of those sectors that have really helped drive the growth rate from about 8% to the current 10.7%.
Yeah, John, one of the things, and Guy and I, we see it every day. We talk about it. We get asked about it, the multiple in the S&P 500, what is contributing to that? And I think a big part of that, and I think you have some views on this, is profit margins right now. And it's not something that I think a lot of folks going back again a couple quarters with the tariff situation thought that we'd be in the situation that we are as far as S&P profit margins. Speak to that a little bit.
Yeah, so we wanted to highlight the profit margin in this podcast because, again, as you mentioned, there was a lot of concern coming this earnings season about the impact of the tariffs, potentially a little bit higher inflation. But S&P 5 companies, through a combination of either cost cutting or price increases or managing costs, have continued to see profit margins go up. So as of today, the blended profit margin, combined the actual and estimated results, is at 12.9%. That'll be the seventh. If we hold there, that'll be the seventh straight quarter of increases for the profit margin. And we're actually getting to the point where we're getting close to the peak profit margins we hit back coming out of COVID. So back in 2021, we hit a peak of 13% coming out of COVID. That's a peak over the last 15 years. And obviously we're at 12.9% today. And part of that profit margin, we're also seeing very strong revenue growth. Revenue growth is at 8% this quarter. Again, highest revenue growth we've seen in 4 years. So despite some of the concerns coming in, companies are holding up in terms of profit margins. And if we look at 2026, the expectation is even for higher profit margins as we move into the start of next year.
Topics discussed on earnings calls have been varied. There's a new entry in this quarter, and that's government shutdown. But the one that sticks out to me here, John, in terms of fewer people talking about it, are tariffs. Last quarter, I think 72% of companies spoke about it. This quarter, that's down to 57%. So talk to you about the topics on earnings calls slide.
Yeah, I think when we look at the topics on earnings calls, really three key takeaways here. And Guy, you hit on the first one I was going to talk about, the decline in the number of companies talking about both tariffs and bringing up uncertainty. So for tariffs, we're down to 57% this quarter. That was at 72% last quarter. It was actually up around 90% in Q1. So we've seen a steady decline in the number of companies talking about tariffs. So 57% is still a high number, but the trend is that number has been coming down the last couple of quarters. And same thing with uncertainty. We're down to about 45, 46% now. That was at 57% last quarter. So again, fewer companies talking about tariffs, fewer companies talking about uncertainty. I think the second takeaway is, again, inflation. We've seen just a slight uptick in the number of companies talking about inflation. So last quarter, it was 36%. This quarter, it's 42%. So again, not a huge jump, but I think something you want to keep an eye on. We have noticed historically that as the inflation number, that the number of companies talking about inflation tends to move in correlation with the inflation number. So we have seen a little bit of a recent uptick. So something we'll want to watch for the rest of this earnings season and then the next earnings season. And finally, the government shutdown, the big one here, 20% of companies talking about now, obviously no companies last quarter. And we'll have more on this. We're going to highlight this in our earnings insight report coming up this Friday. But the key themes we're seeing with companies talking about the shutdown is that most companies are saying they're not seeing a significant impact at this point, but the longer it goes on, most of them are expecting it to be resolved fairly quickly mid-November. They do point out that if this lingers on or continues on further, they could start to see some negative impacts. So something we'll definitely want to keep an eye on, and we'll have more on this in our report this Friday on what companies are saying about the shutdown. But obviously a big jump there, a big jump in a number relative to what we saw last quarter.
Yeah, John, it also seems like no matter what you want to throw against this market, the economy, it just keeps plugging along a little bit. And given all of those sorts of topics you just mentioned that are being highlighted on earnings calls, you still see analysts looking ahead and saying things look pretty rosy here. So talk to us a little bit about the outlook as far as analysts and strategists are thinking about earnings growth over the next, year or so.
Yeah, so I think a couple of key takeaways here when you look at the outlook going forward. So one, the expectations for double-digit earnings growth are really expected to continue over the next couple of quarters. So there is expected to be a little bit of a dip in the fourth quarter. The growth rate is expected to go down to about 7.5%. But all through 2026, double-digit growth are expected for all 4 quarters of 2026. The other takeaway is that, similar to what we saw last quarter, these numbers, we're 2/3 of the way through the earnings season, and these numbers really haven't come down as of yet. If you look at particularly for they're actually up slightly. So for Q4 of this year and Q1 and Q2 of next year, expectations are slightly up compared to where they were on September 30th. So again, analysts are not taking down their numbers, at least at this point in time. If anything, they've raised them up slightly. And so one other point to mention here, and Dan, I know you talked about valuations. When we look at the earnings, valuations are at high levels. So the forward PE ratio it peaked at 23 last week. It's just under 23 now, with sort of the dip in the market the last couple of days. But that's well above the 5-year average of about 20 and the 10-year average of about 18.5. So we are certainly seeing PE ratios above their historical averages at this point in time, with the expectations for higher earnings going forward.
A lot to take away here. I'll end it by saying this, companies now, 42% of the S&P 500 companies talking about inflation, which actually makes sense if you think about a couple things before we wrap. The fact that the ISM services number came in hot, yields seemingly moving to the upside, and a Federal Reserve now that's not pivoting necessarily, but talking about inflation as a potential problem again, suggests that this is all sort of forward-looking things. And one of the reasons you should absolutely follow your work, John. This is fascinating.
Yeah. So again, thank you for that. And like I said, we have about 1/3 of the earnings season left to go. So we'll have a lot of the consumer companies. So again, we'll see where things shake out. But so far, it's been a pretty solid earnings season overall.
He is John Butters. He is the senior earnings analyst at FactSet. You know that. I'm Guy Adami. Dan Nathan, take us out.
All right, my man. Well, you know that your work is really important to what Guy and I do. We appreciate it again. So we look forward to having you on the market call again really soon, John. Thanks so much.
Great. And Guy and Dan, thanks again for hosting this podcast. Appreciate it as always. Thank you.